Hi everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive in, take a look, see what's going on today. If you want to follow me, it's @_finance. And if you want to join our community, finding-value.com. We got question and answer sessions on the weekend, midweek updates during the midweek, going over individual companies of the companies that I like, entry points, and all that stuff is on there. If you want some opinions about the market, definitely sign up. We've got a special coupon code. Special is the code. You can save 50% on the first month on a monthly membership and a larger discount on the yearly membership if you'd like to sign up for a year. So coming on in, we have NewsLink, Casper, we've got URA divided by Apple. After 2 decades of Apple outperforming the uranium miners ETF, we're now seeing a monthly breakout in the ratio. It is suggesting that uranium equities are starting to take the lead. Now, we're going to start to see this across the board. We're going to start to see crude oil outperform tech. We're going to start to see a whole bunch of different commodity sectors start to outperform financial assets. Financial assets are bonds and equities like the S&P 500, Dow Jones Industrial Complex, or Dow Jones, I should say, Industrial, and tech stocks. This is the big rotation. It is all going to occur. It takes time. A lot of people will forget about this as it will continue to progress. They think it happens immediately. Oh, this is going down. It's not happening. Well, when you end a 40-year decline of interest rates, it takes time. It takes time for people's minds to change. They need to get hit in the nutsack a whole bunch in their account, losing money against other sectors. Yes, they could still be bragging about how awesome they've done in the technology sector, but they will get kicked in the nuts eventually, and they will underperform. URA, uranium, silver, gold, platinum, and other sectors, oil, energy. It'll be a good nut punch. It will. It will get them in the nuts hard enough where they can feel it in their gut. And they're going to have to be forced to sell and chase and do the FOMO stuff that most regular zebra part of the herd people will do. It's just the way that the markets work, and it's hard to kind of get yourself out of that mindset. Your entire life, growing up, all you want to do is become part of society, to be accepted by the cool kids, to wear your Nike shoes and your Gerbo pants back in the day. Yeah, be accepted. And now it's good to be out of that herd, out of that crew, and be profiting from the herd as they FOMO back and forth. Bob Coleman, platinum update. Another 6.5% of physical platinum in the registered category backing the futures contract was transferred out. 6.5%. Guys, there's not much eligible platinum in inventory. It's thin. Dollar-wise, it's nothing. Millions. It's measured in millions of dollars, guys. I think eligible, what is this? 87 million, is that ounces or dollars? It's probably in dollars, or it says troy ounce, platinum troy ounce activity. That was 6.5% transferred out. That's probably in dollars is my guess. So not that much, measured in millions, not billions. We've got those well-pointed data-driven analysis from slides 2, 3, and 4 did a superb job of highlighting the price versus value disparity in the offshore drilling space. Yet, the key takeaways are still too early, no urgency to buy, rather buy it 20% up. Well, they're just trying to be a part of the herd. Guys, this is a tough game. It's a tough game. Even the people who are writing still don't want to write stuff that will get rejected by the many. So it even impacts myself, because when I go, if I were to give you straight up opinions, and I give a lot of people on the website straight up opinions, it's going to feel like I'm wrong. And this is where people protect themselves. Still too early, no urgency to buy, even though that's the wrong thing. Maybe they don't know how to read charts. If you read charts, we've got inverted shoulder, head, shoulders all over the place. It's buy time. It was buy time weeks ago, months ago. Should have been buying the whole time. Go listen to the conference calls of these companies. Doesn't sound too bad to me. That's what I'll say. Gives you more confidence. Go look at the insiders. What are they doing? They're all buying. Think about it. Insiders are buying. Good chart patterns. Conference calls didn't seem too bad. Well, seems like a buy. Huh, interesting. Now here's the charts. Let's look at the charts real quick. Here's the key takeaways from investor meetings in London. Looking attractive, but too early. Little emphasis on asset values, earnings, all that matters. Sideline investors are getting interested in the equities. Apart from niches, this is more of a credit story. There is no urgency to buy. I would rather buy at 20% up when we have sight of recovery. Investing now could be dead money for years. What are they not doing? Oh, that's the overall rig sentiment. That's the sentiment that's out there right now. Overall valuation looks attractive, but needs triggers to regain momentum. Good pricing driven share recovery from bottom. Earnings not really attractive. We need to get rid of 15 rigs. The jackups there, a lot of focus on bore, shelf, and PLSV cash liquidity. It's only a credit play, quote. Naturally, much talk about Pemex, Aramco. People still surprised when we mentioned rates in the 70s and 80s. Generally less confident on jackups than UDW, but we also get a sense that it can't get any worse now. That's kind of what's going on with these things. This is the current valuations of some of them. Asset values decoupling from day rates. And then we've got near-term estimates dictating share price. Shoulder, head, and this was before. You're going to create another shoulder where people get scared, and then we come on up. And we've already broken through. We've already broken out of this right now in June. So what does this mean? Why am I showing you this? You can't depend on analysis. You can't depend on other analysts. You can't depend on basically anyone because they're all subject to the same thing, conformance. They are a victim of conformance. They can't tell you their honest opinion because they're a victim of conformance. In order to be good, in order to be great, you need to not conform. You need to be having your own opinions. You need to gain an edge. How do you gain an edge? Oh, wait, there's the 3 pillars that I show on the website. Ratios, cycles, market conditions, and technical analysis. That is what gives you the unbiased opinions, the unbiased chart patterns. It gives you how big money is positioning. The bigger cycle will provide tailwinds behind you, and you need to be cognizant of those tailwinds that are behind us. You need to understand that they're there. Because guess what? If you mess up an entry, you can still wait and let the tailwinds carry you downstream. That's how you do it. And you still buy under valuation, obviously. Breakwave. Oil prices softened on Wednesday as markets assessed the outcome of U.S.-China trade talks, yet to be reviewed by President Donald Trump, with weak oil demand from China and OPEC Plus production increases weighing on the market. Wait a minute. That's what they sent out, but oil was up massively. Guys, they're trying to push the energy market down. They're trying to push rates down. So I want everyone to understand this. They own the news. They put out what they want you to hear. They want oil prices down. They are going to do everything they can in their power to get it down. They're going to try to jawbone it lower. You know what? We don't have the inventory. It's not there. Well, jawbone it down. Send out negative news. Get people scared. So they're trying to manipulate and control the situation through the news, through articles, through whatever means they can. And everyone is just going to conform to the herd. They don't want to be outside of the herd. That's how you get slaughtered. Zebras that move outside of the herd, their predators can focus on them. If they're in the herd, they blend in, and predators can't pick one of them because they get confused on where to go. Humans are the same way. They get confused. They want to be a part of the herd. They don't want to be out there where things are vulnerable. Once you figure out that smart money's positioning when they release this garbage out, you start to figure out the game that they are playing to create entry points. They scare you. Maybe it's a tariffs with 150% tariff. They create fear in the market so they can take a position. Do you think that was by happenstance, or do you think it was created on purpose? Now, someone would say, "Well, that's a pretty you're going out there. That's you're going out there ways." It's like, well, did I mean here? I'll show you what was created because it's important to know what was created. Here's the news release here. Here was the 90-day delay, and here's your shoulder, head, shoulder pattern. And now the follow through to the upside. People got afraid, they got scared. $40 oil, $50 oil. The news came out and scared everyone while they accumulated. Interesting. Interesting how I pieced that together, right? Right. Here's some more. Platinum to gold ratio showing extreme price action as we break through the downtrend. Couple of things I want to comment here. People told me platinum looks horrible down here. While I purchased all through this declining ratio, I purchased a whole bunch of platinum. Why? Well, we're underneath the cost curve. We've got a ratio that's an anomaly in history, and now we're breaking out. The dollar value of platinum did not go down here. This was created by gold going up. But why would I buy gold in the near term if it's peaking against platinum? I would be buying platinum. It's the smarter move. It's the more logical move. It's if I were to create, let's just do this here. I'm just going to draw here. If I were to create the value of platinum versus gold, we are out here on the tail. This is a standard deviation curve. This is our platinum to gold ratio, right? That's a ratio here. Here's when out here, conversely, gold to platinum is over here, where gold is the most expensive it's ever been to platinum. And I can buy it when platinum's the cheapest in history. Well, damn right, I'm going to buy the living crap out of it. And no, I'm not going to conform to everyone else. I don't care. That's how you get money. You just do opposite of everyone else for the most part. And you know with certainty that you're cheap compared to history. And there's other things behind this platinum gold ratio that's not being shown here if you take a very long, big picture view. Yes, maybe that means that you need to be more well informed than everyone else. Maybe you're super smart money. That's what we're going to turn into as we get in this. Just going to leave this right here one more time. Wouldn't have done it if dude didn't rage block me. So Mark, he says, a moment's silence and our heartfelt sympathies for anyone stupid enough to have sold gold and bought platinum. And that was just recently. I guess I'm really stupid. I did transfer some of my gold into platinum, and I'm a huge platinum holder, far larger than gold. And I must be really stupid. But guess what? This is exactly what bottoms look like. This is what it feels like. This is what the stuff that you're going to see as an investor is going to be in your face. And you might even see it from people who are smart, that you consider to be an expert, because they are also subjected to a victim of conformance or conformity. They want to conform. They want to fit in. When things get bearish, they get bearish. When things get bullish, they get bullish. They need to fit within the herd. For some reason, growing up as a kid, yeah, I wanted to fit in the herd. But it's all started in college when I just completely diverged. It started in college, and then I diverged further along as I got older. As time has progressed, I'd say it really hit me in my, I'd say 30 years old, 29, 30 years old. I really started to diverge. I didn't chase titles, status, didn't give a crap, didn't care about it. Now, there is still a ticker in the back of my head that measures it to some degree. The hierarchy is still back there, but it just doesn't, I don't do anything with it. I know it exists, but it's just back there. It doesn't do anything. Javier Blas says, oil market, the AP is reporting that Washington is preparing to evacuate non-essential staff from American embassies in Baghdad, Kuwait City, and Bahrain due to the potential for regional unrest. Let me show you something here. This is what high level thinking is, all right? This is what's going to come out, and I'll tell you before it even happens. I've been bullish on oil for a very long time. I've been in the camp that we're going to four or five, three, four, $500 a barrel oil, something way higher. All right. This is your fractal. This is known as Elliott wave. I overlaid on top of oil. The market is lining up for a gigantic move in oil. This market is already lining it up ever since 2020. In fact, it was lining it up the entire time. This is a consolidation fractal, and this here is wave one, wave two of Elliott wave, and we have a big wave coming right in front of us. The news is going to come out and blame it on something. Who controls the news? The people do, yeah. The government and all that. The elite, call it. But here it is. This is what's going to happen. The fractal's already there. Everybody's already pricing this in right now. It's along the way. The pattern says it. Now they need an excuse. Here's your excuse. They're going to blame it on something. Here it is. That's my opinion. This is going to happen no matter what excuse they make. In my opinion, it's coming. And it begins. Oil, crude oil futures daily breaking out. There we go. Looking good. Shoulder, head, shoulder. Looks pretty much like a bottom to me. And here's the scare. The scare pushed us below to a false breakdown. The scare is what caused people to go short, and we're going to squeeze them. We're going to squeeze them to death. And there's your false breakdown. That's how it works. Buying the false breakdown means you are very good at what you do. HFI research, U.S. commercial crude storage is much lower than where we were at this time last year. A tighter storage environment has prompted WTI time spreads to surge. The Big Four inventory is 44 million barrels per day lower, or sorry, that's total, 44 million barrels lower year over year. There we are. But yet the price was higher in all these other years. How did they pull that? They being government and officials. Big Four crude, so this is Big Four storage, way down. The only year that's below this is 2022 when we were at $150 oil. Shouldn't this be $100 oil, $90 oil? Should be. Yeah. Time spreads ripping higher. Why? Because demand is pulling it, and it's like almost as if crude oil is being held down. Well, maybe it is being held down. What happens when you hold something down? It will fly back in the other direction. U.S. Dukes, which is drilled uncompleted wells, are essentially at working inventory levels. There will be no quick fix to production declines. So you're telling me if oil prices were to rocket higher, there's no quick fix. We are screwed. Yep, that's what I'm telling you. And we're going to have to bring on a bunch of rigs too. And guess what? Rig counts have been falling. Almost as if somebody pushed this oil price lower on purpose. Maybe someone who was, I don't know, came out with a plan of 333. Trump ascent, maybe? I don't know. Maybe they were trying to do something there. Maybe the PPT, plunge protection team, was in there doing something. I don't know. Maybe. Maybe not. Selling rules. If you don't sell early, you sell late, says William O'Neill. It says sell while your stocks are still moving up. It's counterintuitive since your stocks will look strong as you sell, and they may go up after you cash out. But to consistently turn paper gains into real profits and avoid getting caught in declines of 20, 40% or more, You need to proactively sell while your stocks are still rising. Take most profits at 20 to 25%. You don't need to hit a home run with every trade to be successful. So, as Bill O'Neill says, your objective is to make and take significant gains and not get excited, optimistic, greedy, or emotionally carried away as your stock advance gets stronger. Why 20 to 25%? Because most stocks typically pull back and correct after rising 20 to 25% from a paper breakout. In most cases, you're better off locking in your gains at that point. That way, you avoid watching your profits disappear as the stock corrects, and you can potentially shift that money into other stocks that are moving up. By following this disciplined approach, you'll regularly nail down that kind of solid gains that lead to large overall profits in your portfolio. You guys agree with this crap? Really? I mean, this is garbage. Now, I tried doing this to some degree when I was a younger, more impressionable person. Now I look at this and I'm like, this guy is absolutely retarded. Sorry, I don't want to use retarded. Stupid. Very stupid. This is a horrible strategy. I mean, this is a way that you can maximize taxes if it's in a taxable account. Um, Most of the time, it's not as easy as what he makes it seem. And if you are buying, let's say it's breaking out of a gigantic base, and you're going to buy that, well, why wouldn't you hold on to it for the big, big move that goes up 2,000% or two hundreds, hundreds of percents, maybe it's 800%. Why would you sell a home run? Well, you don't need to hit home runs, he says. Do you know how hard it is if you get a few or not thousand baggers, 1,000% returns, which is a 10 bagger? Do you know how many successful trades you will need at 20 to 25% and also using the losses too? Do you know how long it would take you to get there? Will you ever get that type of return? I don't think so. I honestly think that this strategy right here will never net you anywhere near the success that buy and hold would net you. Not even close. So why use this strategy? I don't. I reject it. It's garbage. And I'm just sharing this with everybody. I don't think this is a good strategy. But people want to get rich quick. They want to be told things. Oh, you just need to put in stop losses. Oh, you just need to work harder. The hell is working harder going to get you? You're going to wake up at 4 a.m. and read a bunch of news articles to pretend like you think you know where the stock market's going to go. Smart money is creating the articles that you are reading. Smart money is positioning and using the articles in an opposite fashion. They're telling you to go out and buy it while they offload their shares to you. They're also telling you that you shouldn't be buying something, that oil is going to go to $40 a barrel while they're in the back door buying it all up. That's the game you're playing, guys. If you don't know the game you're playing, you're going to get smoked. So how do you beat people in that game? Well, that's what I tried to solve. You have to be more patient. You won't be perfect. You won't nail things in the short term. But if you can nail it in the long term where no one else is looking and no one else is using strategies, well, that's how you take advantage of it. You go longer than they do. You are more resilient and persistent. You can wait longer out. You can wait them out. And if that strategy returns far more profits than this strategy, then that strategy is better. And that's exactly what I went through. I went through all the strategies, all of them. And the only way that you can maximize your returns is to identify bottoms, to buy when it's ultra cheap, and then to be more patient than everyone else. Does it suck? Yeah. I used to deadlift quite a bit. I was a mid 600-pound deadlifter at a little bit over, I was probably 220 pounds weight wise. You think I did that in one day? You think I did that in 1 year? No, it's many years stacked upon each other and continuing to figure out how to optimize my strategies of lifting, how to optimize my form, my lifting strategies, having enough rest and nutrition, all of that it all matters. And I just did that because I wanted to try to see what I could push my body to. Now, investing is very similar to that. It's trying to get the 600-pound deadlift plus. That is your returns, your 1,000+% returns. It's going to take time, and you're going to have to figure out strategies to get there. I think I've got a pretty good strategy to replicate over time, but it takes time. Sometimes it can happen quickly. Sometimes it takes, 4, 5, 6, 7, 8, 9, 10 years. It all depends. And some people say, well, that takes too long. You don't have another option. There is no other option to do it. I hate to say that to you. Doing this short-term trading, and you could get lucky, but you can't consistently get lucky. And that's where, once you figure out the strategy that best works, and that's not just best works for you. This isn't a My Page or MySpace or whatever the heck you want to call it. It's not something that fits to you and your thing. You need to fit to the market and what the market will give. It's adopting strategies that works for the market. It's not, well, I'm a short-term trader guy. It's like, well, then be broke. I mean, none of those people make any money. That's the honest truth. None of them do. Day traders, 99.99% go broke. Zero. Like they get wiped off the face of the market because they literally get zeroed out. Then you start swing traders. They don't make any money. And the longer you adopt in terms of time frame, the more money you make, and the probability of success goes up. I mean, you're arguing with probabilities and statistics at that point. JSG says, many of us have been asking why the relationship between inventories, oil, and price have broken down the last 18 months. Could be part of the answer here. And it's my new paper with Oxford Energy. Price correlation to inventories drops to 0, while correlation to fund positions reaches record highs. The oil market is now entirely driven by the battle of two algos: risk parity versus crisis alpha hedging. And this is oil prices and positions of money managers, and that relationship of positioning and WTI. Here is WTI per barrel and US inventories in millions of barrels. And you can see there's a scatter there. But if you break down the scatter here, and there's a correlation, which is an R-squared value of 75% confidence level, your positions and WTI is really what's setting the price. It's your market positioning. And market positioning, there's two algos: risk versus parity and crisis alpha. Risk parity and crisis alpha. The Great Marti says, yields look set to break higher as equities continue to rise. Bullish setups. That this is not good. It's very bad, with the yields all wanting to break higher. I agree with him. They look good to go up. $77 silver, and this is Gold Ventures, putting some price targets on a potential silver breakout. I think we'll break, and then I think we'll have a return move on top of the pattern, and then we're going to go up a lot after that, like a lot. Jesse Livermore says, the stock market is never obvious. It is designed to fool the most of the people most of the time. So it's designed to fool most of the people most of the time. The gold bug dream chart there, it says gold, silver, and mining stock investors need to be open to an April-October seasonal inversion, where instead of cyclical swoon, it says this metals market rally intensifies through the summer and continues into the month of October. A breakout is in play, and a rally into October would be just the opening act of a multi-decade bull run for gold and silver stocks. I like the multi-decade portion. Providing incredible excitement for gold bugs around the world, says Stuart Thompson. This is a downward move, shoulder, head, shoulder, and then we're going to get a breakout out of the base, a retest that we're seeing in uranium. We're seeing that in MU, which is the agricultural ETF. It breaks out, does a retest, and then we're going to go into Stage two, which is a gigantic big bull market. It's happening all over the place in commodities. It's everywhere. I purchased the shoulder down here in a whole bunch of different things. It looks fantastic. Brady says, been saying lately that the secular bull for junior commodities companies is about to resume, and it now is. Smaller companies are now moving. This is the TSX Venture Weekly, and here we are moving, breaking out of some downtrend lines. Looking good. Get a breakout, retest, and then boom, the slingshot. EIA inventory moves. So this is talking about inventories of oil. So crude is down 3.6 million barrels. Gasoline distillates are up about 1.5 million each. Anonce or anus, to you, how you want to, I think it's anonce, but it's LNG unlikely to displace coal in India's largest coal consuming sectors. I agree. Fertilizer sector accounts for nearly all of India's LNG demand growth since 2016, owing to high government subsidies. LNG, but coal's going to keep burning, guys. We're going to keep burning it. Warren Buffett says, in the business world, the rear view mirror is always clearer than the windshield. And that's people looking at backward facing metrics. When you look at things in the future and people are trying to make forecasts, it's a lot more cloudy. We don't know what it looks like. Hence why valuation is the most important thing. It's not about making predictions. It's about getting an undervalued assets, sitting in it, and then waiting for the right market condition to come. The problem is no one is perfect on predicting the right market condition. So you might have to wait a little bit for it. And that's where people tap out. They tap out. I would say now that more people tap out, they have less resilience for patience than any time in history. And guess what? We can take advantage of that. Those are the ones that are going to lose all their money. WTI oil price target 72 on the point and figure chart. Bullish. I repeat, lithium to plus 20,000 second half of 2026. I tend to agree with them. Lithium's going to get lit here. We're very low in lithium. I think we've got a great opportunity in lithium. I'm taking advantage of it. I really am taking advantage of this bad boy. And if you want to know the companies I'm going in, you can follow on the website. A month is a long time in oil markets. Here's Sankey. He's an expert, oil expert. Oil prices will drop to $40 range following OPEC Plus decision, predicts oil analyst Paul Sankey. He's a victim. Did you know that he also called for $150 plus oil when oil was over $100 a barrel in 2022? Mm-hmm. Victim of conformity. The magic is in the last 20%. Pain is the filter, few pass it. So let's see what this is. Let's talk about this. It says, I have a theory. If you put in 80%, you get 80% back. But if you put in 100%, you get 1,000% back. The last 20% is where the magic happens. Because almost nobody is mad enough to go all in. Only a perfect storm of delusion, obsession, and a pinch of childhood trauma makes that extra 20% possible. It's the part where you keep going long after logic says retreat, where your biggest weakness becomes your biggest strength, an inability to stop. Because at a certain point, success isn't about talent or luck. It's about who's willing to suffer for the longest. Pain is the filter, few pass it. I would agree with some of this, only some of this. There are certain things that people can go 100% in and they will still fail. That's reality. And there are some people that will put in 20% and get 1,000% back. They're just that talented. When you start to work at the edges, so when I talk about the edges, when you draw a normal distribution curve, you've got the tails on those curves. And for a lot of people, this might be true, what they're saying here, depending on where you're located on that distribution curve. But there are people that are on the tails of those curves. And some can put in 100% effort and they'll have absolutely nothing to show for it. And then there are going to be people who put in very little effort and they can change the entire world. They are just that gifted, that talented. I'll give one example. Bo Jackson, in terms of being physically gifted for sports, I don't think he needed to put in 100% necessarily and do well as a professional player in a lot of sports, not just one. He was a multi-sport professional athlete. Um, I think he did well, and I think he did it. He probably put in effort, yes, but he was also one of the best in multiple sports. We're talking all-star caliber in multiple sports. I don't think a lot of people putting 100% of their effort could ever necessarily replicate what he did. There's a lot of people, including myself, that I'm just not good enough to do what he did, no matter how much effort I put in. Now, there are other things where effort matters more because it's easier. Becoming a doctor, if you're over an IQ of maybe 110, 120, then yeah, it's just effort at that point. If you're smart enough to get in, and then it just becomes an effort thing. But to be the best or to do something, yeah, effort is required, yes. And you may not know what your ultimate limits are, but you also need to be a realist to know what your strengths and weaknesses are. And if you go into something that you don't like and it's a weakness, probably not going to be successful because you're not going to go and become obsessed with it. That's what I'll say. But there are limitations. Desmond Miles says, wow, Paul Tudor Jones on Bloomberg. Here's his trades. Dovish Fed chair, negative real rates to get out of the debt trap. What negative real rates are is that the bond market will pay less in interest rates than the real rate of inflation. So they call that real negative rates. The steepener, 100 plus bips, short-term rates down 2.5% plus long-term 3.5%. Dollar down minus 10% a year from now is his opinion. Bitcoin, gold, stocks, volume adjusted portfolio. Run the economy hot plus grow your way out of it is what they're trying to do, in his opinion. And that's what they have to do to make this debt a little bit more manageable. Brady says, been saying Palladium is about to start its bull market, e.g., it's in the link below. And now, with the weekly breakout just below, we have confirmation of that Palladium is now on its way. Another 21x move, while going parabolic, looks very likely. The commodities bull is a true get out of the rat race opportunity. Even before I called the commodities bear market low back in 2020 in real time, I said platinum and palladium will outperform gold and silver in the coming bull market. Pioneering platinum and palladium case. Many will have started to wake up to platinum and palladium and saying they saw it coming, which they did not. But go with us. I've played these sectors for decades, and here's the breakout in palladium. Platinum already broke out. Palladium's breaking out. This looks like a heck of a party. You know what's really crazy? We already positioned at the bottoms for the platinum group metal mining companies. And we are sitting in them, waiting. And if we see platinum and palladium, probably rhodium too, outperform gold and silver, then we got one heck of a position on our hands here from where we positioned on the website. So for those that are on the website listening to this, stay long, my friends. We've got a long way to go. It's going to be a fun ride riding it with everybody together. Here's one. There's no peak in oil demand on the horizon. Our projections are that oil demand will go and surpass 120 million barrels of demand a day by 2050. Guess what, guys? We don't have the oil. I don't know if we've got the oil to go 120 million for that long. I don't know if we do. I don't know. I'm so bullish on oil. I'm bullish on coal. Say that again. When drilling activity declines to this extent, it's not just a near-term production cut, it's a structural throttling of future supply capacity. Shuttering oil wells, especially unconventional ones like shale, isn't as simple as flipping a switch. Once a rig is idled, crews are disbanded, capital is reallocated, and permits may lapse. Restarting production requires not only fresh capex and labor, but the reassembly of a complex ecosystem of service providers, equipment, logistics, and regulatory alignment, often taking 6 to 18 months depending on jurisdiction and depth. This lag effect creates a powerful asymmetry. Supply destruction happens fast, but supply restoration is slow and uncertain. If global demand rebounds before the supply side has time to recalibrate, we risk a sharp price spike, not just due to fundamentals, but due to market participants front-running the inevitable scarcity. It's a classic boom-bust setup forming quietly in real time. The longer this underinvestment persists, the more violently prices could respond when the cycle turns. In a world obsessed with near-term disinflation, this is the kind of deferred energy risk that becomes headline inflation shock when it finally catches up. Few are pricing in that dynamic now. I'm in it, guys. That's what I'm showing in the charts. That big price spike. And I'm positioned for it. Hell yeah. Hell yeah. Freight futures AM update. We've got Capesize, Panamax up in dry bulk, 3%, 2% respectively. And tankers, VLCC is down 3%, Suezmax down 1%. Another Grady one for silver. Silver's now a historical breakout mode. Many are still in a bearish mindset and sell as soon as they have some profit. If one cannot change mindset when the market changes character, making life-changing money is not possible. And most need help with that. And that's exactly what I was talking about earlier with that mindset. Oh, sell at 20 or 25%. This isn't the time, boys. This is not the time. You got to change that mindset. This is bull mode. The mother of all very probable cup and handles, the bigger the base, the higher in space, it's all coming. Projected move, $248 according to Grady. I'm in the 300s. That's my projected move for the big bull market. Not going to happen tomorrow. Just don't think of it like that. It's going to take a lot of time too. It's coming. Oil demand growth to continue, no peak in sight, OPEC Secretary General says. Nick Sleep says, we do not have the faintest idea what share prices will do in the short term, nor do we think it's important for the long-term investor. That's where you need to be. That's where you need to be. Calvin Coolidge, he says, nothing in the world can take the place of persistence. Talent will not. Nothing is more common than unsuccessful men with great talent. Education will not. The world is full of educated derelicts. Persistence and determination alone are omnipotent. I think that's more the case with people who are capable. There are people that can't do certain things. I will say that. And if you're under the IQ of 83, you can't even join the army. It's just not going to happen. But most of us are capable, and then it becomes down to persistence and determination. I sincerely hope that no one is taking the EIA. Okay, I talked about that last one, so we're going to stop there. So give me a thumb up for the content. Subscribe to the channel. It looks like my camera pretty warm in here, so here it should be coming back. There we go. That's all I've got for today. Thumb up. Of course, it broke my train of thought, but that's all I've got. We've got a Sunday question and answer session at 5 p.m. Mountain Time. And I'll go over whatever questions you guys have, and it's on Sunday. So that's all I've got. We'll catch you next time. This is Finding Value.